So if you go back to the end of 2022, you might recall that we were one of the only communities that was pushing the bullish buy button constantly. And it was because of our belief in the fact that we thought company earnings and our economy would perform greatly, even as interest rates went up to help tame inflation down. And again, we were some of the only believers in that thesis, and that thesis actually ended up playing out. And throughout 2023, we've made a ton of money as a result of being early to that trade. As the rest of the stock market kind of caught up with us and started to realize, oh, yeah, we're fine. Our economy's great. Company earnings are great. And interest rates are 5% already. That's when everybody started to buy back into the stock market. And we made a lot of money as a result of that, being early. Now, today, I think there's kind of a common misconception out there from bulls that believe in order for this bull market to continue, we have to have rate cuts. I don't think that's the case at all, but I think that's why you have such a bias from investors and influencers on social media that are bullish on the stock market and are calling for rate cuts. We need rate cuts now. I'm not in that camp. I remain bullish, but I don't think we need or we want interest rate cuts. I actually believe that right now, with interest rates at 5%, it is actually stimulative to our economy rather than restrictive. And I know that might sound bass-backwards to a lot of you, but at least hear me out. And I think this is a really interesting thesis that I haven't heard anybody else talk about. So again, if you guys are new here, returning, not yet subscribed, please subscribe down below. On this channel, we come out with all sorts of videos like this, real deep dives into real data in the stock market and the economy. And all of the thoughts I share on this channel are of my own research. I draw my own conclusions. I don't regurgitate information that other influencers or YouTubers share. And I think that's why we have one of the fastest growing stock market YouTube channels. I'm incredibly blessed. I'm incredibly grateful for each and every one of you that decided to click on this video, but yeah, let's discuss this. So it's one thing to say that interest rates right now are not restrictive, but it's a whole other thing to say that they're actually stimulative. And I'll get into that, but first, of course, we need to realize, at least based on my research, interest rates aren't restrictive. And then we'll kind of go down that bird walk of it actually being stimulative. So why does the Fed choose to raise interest rates? Well, a simple Google search will tell you. They raise rates to slow down the economy and bring inflation down as a result. The lending tree definition says the Fed raises rates to slow the amount of money circulating through the economy and drive down aggregate demand. That's what the Fed is trying to do when they raise interest rates. They want to make it harder to spend your money, which decreases demand and ultimately decreases the upwards pressure on prices. So for interest rates to be truly restrictive, they have to be hampering demand and actually slowing down the economy. But based off of anything we look at, really, we can start with GDP. Our economy remains in growth mode, and arguably the growth has been accelerating more than it's been decelerating. We can look at this chart on the screen here, which shows real GDP, and then the Atlanta Fed Now GDP model, which basically estimates what the future quarter's GDP report or growth will be. And even that forecasts that Q1 GDP growth will come in at 2.9%, essentially 3% GDP growth. What about that screams that interest rates are restricting our economy? Well, of course, nothing about that says that interest rates are restrictive. And then we can look at, okay, we talked about how demand is directly impacted by interest rates if they're restrictive. And we can see that based off of real final sales, which is the bottom chart here, real final sales also have been accelerating more than they've been decelerating, which again is indicative that interest rates right now aren't restricting our economy because demand remains robust, if anything. And we can look at any demand measure we want to look at and see that demand remains robust. It's not just real final sales that we can look at. We can look at numerous data points and numerous data sets that will tell us the same thing. Demand is there, and demand is arguably still growing. So that too makes you beg the question, what tells us that interest rates are restrictive? And in fact, if you ask me, just based off of my research and my data points alone, the only thing that really tells you interest rates might be restrictive is the simple fact that the federal funds rate is above the rate of inflation. But that's kind of a lazy way to measure if interest rates are restrictive or not. And just, again, based off of my research here, I don't think interest rates have reached that point of restriction. I think interest rates right now are actually stimulative. Now, I want to be clear. Don't hear what I'm not saying. Sure, there are certain sectors, certain segments of our economy that are feeling some restriction from interest rates. But overall, net, I believe interest rates are stimulative. And one of the biggest concerns that I hear from investors today is the amount of debt the United States government is in. And I agree, it is a major concern. It's something I'm going to have to keep an eye on for the rest of my life, for the rest of my investment career. This is something I will be monitoring. And a lot of this has to do with that net interest paid on the federal government's debt is going to exceed $1 trillion. I mean, already if we look at this data, since March of last year, so from March of 2023 to March of 2024, the federal government had to pay $787 billion on their debt. As interest rates have gone higher, and some of this is refinanced, and the government is forced to pay even more interest on this debt, again, this will surpass $1 trillion of net outlays that the government is paying to service its debt, which sounds crazy because all they do is print more money so that they can pay off this debt, which just increases inflation, which means you have to raise interest rates again. It's a whole messed up system that eventually it's going to go bust. It will. Every single economic, monetary system in history has eventually gone bust because it's a cycle that doesn't make sense, that is simply built on hope and promises and belief that a piece of paper has value. The piece of paper being the US dollar, of course, but that's a whole other topic for another video. What my point here is that I don't think people realize this. Any federal government outlay, including net interest paid on their debt, is stimulative to the economy. Whether it's net interest like we're talking about today, Medicare, income security, Social Security, national defense spending, healthcare spending, any government outlay, anything the government spends money on is stimulative to the economy. So this $1 trillion that the government's going to have to pay in interest on their debt is stimulative to the economy. Why would that be, and why does it matter? Well, it's because the total amount of marketable treasury securities outstanding is essentially $27 trillion, and this is $27 trillion worth of debt that is in the public's hands. When I say the public, I mean international governments, I mean corporations, I mean individuals, billionaires, millionaires, thousandaires, everyday citizens, everyday consumers. These are the people, the public. The public holds the government's debt. So whether it be the interest that the government's paying on their treasury bills, the interest they're paying on their treasury notes, the interest they're paying on their treasury bonds, or the interest they're paying on their treasury inflation protected securities. I mean, this sounds complicated, but it's not. Every single dollar that the government has to spend to service its debt is going into the public economy. I mean, just look at this chart on the screen here. As of May, there are $6 trillion invested into money market mutual funds. Out of the $6 trillion, 3.6 of it is held by institutions and 2.4 trillion is held by retail. So the average everyday Joe like you and me, these are the people that hold money market mutual funds. And you can see that since the beginning of 2023, the amount of money in money market mutual funds has absolutely skyrocketed. And what is this money? Well, it's risk-free return that consumers and businesses and governments can get just for saving their money. Even though savings interest rates at banks still are terrible, even if you don't put it into a high-yield savings account, the interest consumers are getting on their everyday savings account has increased fivefold. And again, this is return that consumers and businesses are getting for no extra work. And what does that do? It puts more disposable income into consumers and businesses' pockets. From there, it's up to the consumer or the business to decide what they want to do with the extra money. Consumers, we like to spend our money, which boosts the economy. Businesses, which I will discuss in a little bit, have seen their profit margins, cash levels, and as a result, their dividends and their capital gains they're able to give to shareholders absolutely skyrocket just because of the extra cash that's sitting on their balance sheet. But let's talk about the consumer. The net worth of all households equates to $156 trillion, with a T, trillion dollars. Households have a lot of money. And what's the generation that's just entering retirement age? It's the baby boomers. They're retiring with $76.2 trillion of net worth. These are people leaving the workforce, and as a result of the great virus crisis, they have an extra itch to go spend their money, take that vacation, go out to a restaurant, pay for a family meal. They have that extra itch, and they're willing to spend money because they have money. Where is all of this net worth tied up? It's in equities, and it's in interest-bearing assets like bonds, like treasury bills, these risk-free assets that as you get older, you're advised to own more of because they're risk-free. The closer you are to retirement age, the less risk you want to take with your money, which means less money in the stock market, more money in risk-free interest-bearing assets and vehicles like, again, treasury bills, treasury bonds, treasury notes, treasury inflation, protected securities, whatever it is. They have a lot of wealth. They're spending that wealth, but their wealth actually continues to appreciate and go up because of these interest-bearing assets that the baby boomers hold. This is another handy chart here on the screen now. Don't let the complexity of this scare you away from watching this video. I'll explain it to you. The green line, so the line up top here, is equity shares at market value in Q4 of U.S. household net worth. U.S. households hold $47.5 trillion in equities and in stocks. They hold $31.8 trillion, which is the red line here, in equity in houses. So this could be rentals, this could just be their own personal dwelling, but that's another large chunk of their net worth. Pensions, $31 trillion. That's the dotted blue line. The solid blue line is deposits and money market funds, which again, you're getting risk-free return on. $21.8 trillion as of Q4. And then the orange line is equity in non-corporate businesses, $15.8 trillion. I'll discuss in just a second the benefits that higher interest rates have actually given to businesses today. But the purple line, debt securities, pretty clearly a risk-free return or an interest-bearing return, right? Not necessarily risk-free. No debt is necessarily risk-free unless it's guaranteed by the government. But debt securities, $5.7 trillion, and then life insurance reserves, $2.1 trillion. But let's talk about these businesses and corporations. We've already discussed on a basic level why higher interest rates are actually helping consumers. Our consumers today are much more wealthy than they ever have been in history. That's why this time is different. You know, personally, I believe that higher interest rates are only hurting my demographic, Gen Zers, that are looking to purchase homes or assets or farm ground, and we're just really unable to do so because of the prices that are placed on these assets. It's almost impossible, and interest rates aren't helping that. But for the vast majority of Americans, we have a very wealthy country, and it's the most wealthy we've ever been. And any amount of wealth you have benefits from higher interest rates. But anyways, let's discuss corporations and businesses like I said I was going to do. This in turn will also help out consumers, and I'll explain that to you. Look at corporate cash flows and how they have increased rapidly ever since 1950. Corporate cash flows in Q4 were $3.4 trillion. Absolutely incredible. And then we look at this, the corporate profit margins. This is very important to note. Look at how the average corporate profit margin, so this is for public and or private corporations, is 10%. It might not sound like a lot, but let's go look at 1986, for example. 40 years ago, the average corporate profit margin was 5%. Actually less than 5%, 4.58%. So over the course of 40 years, our corporate profit margins have more than doubled. And this is because the largest companies in the world today, they're not these industrial giants like they were 40, 50, 60 years ago. We have software companies with relatively asset-light balance sheets, and these software companies have incredible cash flows, incredible profit margins, and honestly, they have more cash than they know what to do with. And I'm going to switch my screen now to really show this to you. In this Excel spreadsheet, I've looked at Alphabet, which is Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. I call them the mega cap 8. I think that's been termed by Ed Yardeni, actually. I just copied the term. But look at the profit margins on these companies. These are the largest companies in the world today. The profit margin at Google in the most recent quarter was 30%. 30 flippin' flapjack in percent. At Amazon, the profit margin was 7%. Not great, but they also kind of work their balance sheet. They kind of play a tax advantage game over there at Amazon. So the 7% profit margin, it could be a lot higher if they didn't play that game. Over at Apple, 26% profit margin. Meta, 34%. Microsoft, 35%. Nvidia, 55%. Tesla, which is actually a company in its infancy, I would argue, 5% profit margins. And this is also a company that is in a relatively tough situation right now, but their profit margins were still 5%. This will likely grow to 20, 25, 30% as the next round of demand for Tesla's electric vehicles comes around. And boy, this is just really exciting if you ask me. The biggest companies in the world have incredible profit margins, and I've also considered on the spreadsheet the amount of cash they hold on their balance sheet as of the most recent quarter. $108 billion Alphabet holds. Google. They hold $108 billion on their balance sheet. Amazon holds $87 billion. I won't go through this whole list, but total, all in all, these companies hold almost $500 billion in cash or short-term investments on their balance sheets. $500 billion. What can they do with this cash or these short-term investments? Well, they can invest it in risk-free yield, high-yield savings accounts, treasury bills, treasury bonds, treasury notes, whatever it is, risk-free yield that they weren't getting 2 years ago. At a 3% return, at a 3% risk-free return, which is really easy to find, these companies would be adding roughly $13.5 billion of net profit, net income to their balance sheet, to their income statement. For shareholders, $13.5 billion that they wouldn't have otherwise. At 4%, which is average right now, these companies are adding basically $18 billion every single quarter to their income statement of net income and to their balance sheet of cash. At 5%, which if interest rates stay at 5%, which I think they will, I think interest rates have just normalized. Again, I don't think we need to cut rates. I don't think we have to cut rates. I don't think we should cut interest rates. If interest rates stay at 5%, these companies could easily find 5% risk-free return on their money. With $455 billion sitting on just these 7 or 8 companies' balance sheets, they could add almost $23 billion of net income and cash to their company for the sake of shareholders. What does that do? Well, corporations, they pay employees. If they have more cash on their balance sheet, they can choose to give people raises. Those people will go out and spend more money in the economy. Otherwise, the shareholders of these businesses feel gains, real tangible gains in the equity they own in these companies because the net assets of these companies go up, which means the book value of these companies goes up. And then you consider the fact that these companies can reinvest these gains, these returns to grow their business more, or just keep reinvesting it in these short-term risk-free yields. And then they can pay that out in dividends. They can pay that out by doing share buybacks, or again, they can just sit on this cash. And as a result, investors over time will feel capital gains. Their investment in these companies will go up as the net assets of these companies goes up. It's incredible. And again, the reason this time is different is because the biggest companies in the world today are so much different than they were 40 years ago. When those companies were very capital intensive, they needed so much cash to operate, their profit margins were very, very slim. That has changed significantly. I've already covered this. The largest companies today have profit margins that probably average 30%. The largest companies back then averaged 5%, 6%, 7% profit margin. And again, let's remember all of the trillions of dollars that people hold in equities or non-corporate businesses that are feeling benefits from higher interest rates just because of the amount of cash and net income they have every single quarter. And all of this leads to actual economic growth because there's more demand in the economy because people have more money to spend, more disposable income at the end of the day. And again, the largest cohort that's spending their money right now are the baby boomers. They're going out, retiring, spending their money. They're spending their $76 trillion in net worth in our economy. I believe that they're one of the biggest reasons we never saw the recession take place that everybody anticipated seeing. I think the baby boomers and their willingness and their itch to go spend coming out of the great virus crisis has bolstered our economy an incredible amount. Now, again, I want to reiterate, don't hear what I'm not saying. I fully acknowledge that there are small areas of our economy that are feeling some pain, feeling some restriction from higher interest rates. But all in all, I think my conclusion is that 5% interest rates are stimulative. We're not yet over that hump that brings interest rates into restrictive territory. And you can go back to the beginning of this video. We look at demand everywhere. We look at economic growth everywhere, and nothing about higher interest rates right now tells you that they're restrictive. So yeah, it's up to you to decide if I'm crazy or not. I'd love to hear all of your thoughts and opinions about the research I shared today. I always love having that sort of discourse in the comment section. I think it makes us all sharper investors. So don't hesitate, even if you disagree with me, share your thoughts, share your comments down in the comments section. Also, I like to end my videos with this. If you made it this far, it's truly indicative that you support what I do. And as a result of that, if you want to show even more support for what I do here, I'm entirely self-funded. I will always remain independent. I will never take a sponsorship deal because I think my independence is incredibly valuable, and I think you guys value that. I have a paid monthly membership which gets you access to exclusive content, exclusive videos, buy and sell alerts, extra macro and economic analysis, things like that. Consider joining that and supporting me monthly. I greatly appreciate it. You can check that out by hitting the join button located right next to the subscribe button or hitting my Patreon link in the pinned comment. But with that, I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.